So bundled sales really just represent multiple element arrangements. If you think about some language that's common in today's revenue recognition world. So these are going to be arrangements in our industry that contain multiple goods or services that are delivered to a customer. The ones that come to mind most immediately in the power and utility sector are probably PPAs, power purchase arrangements. So you'll have an agreement that has a sale of capacity to a buyer, as well as electricity, the capacity representing the stand-ready obligation to run a plant when called upon, and the electricity just being the actual commodity itself. Another very common one is a green power sale, where a renewable power plant sells electricity and the associated renewable energy attributes to a customer. Those are the three, electricity, capacity, and RECs, renewable energy credits. Those are the three that we've really tended to focus on at this point as a task force. Those are the three that we think are probably the most common and also probably the most material from a revenue standpoint. So we've really focused our efforts on those three and much of the work we've done to date. So similar to today's gap, where we have a multiple element revenue requirement, requirement to go in and identify individual elements within a contract, the new standard similarly asks you to go in and look at discrete goods and services that are transferred in an arrangement and decide whether they should be accounted for as discrete items in your revenue accounting. So in the new standard, this takes the form of what's called a performance obligation. And so the standard is going to ask you to identify the separate deliverables and determine whether they should be accounted for as distinct deliverables or whether they should be accounted for perhaps on a combined basis with other goods or services in the contract and accounted for as a combined performance obligation. One of the ways that you're going to think about this in the new standard is to think about whether the good or service is distinct in the context of the contract, and there's a whole body of interpretive guidance on what that means, and we have to think about how that applies to various elements in a power and utility arrangement. Well, it matters because the answer can dictate the timing of revenue. So if you think about these separate deliverables in a contract, if they're combined and accounted for together, that could lead to one revenue profile, whereas if they're treated separately, that could actually lead to a different revenue profile over the course of the revenue contract. That's a great question, and the answer is still unclear at this point. We've taken a few different looks at that, including looking at different contract types to see if the answer could be different depending on the contract type and the way it was marketed to the customer base. One of the things that we've done, though, in light of the, I'll say, diversity in views around whether to combine or not, is we've looked at each one individually and said, if we weren't to combine, if we were to view each one separately, how would they transfer to the customer and how would revenue be recognized in connection with each of the standalone deliverables? And the reason we've done that is because if the answer is that they all transfer at the same time and therefore would result in revenue recognition across a similar pattern, a similar time frame, then the pressure is really much less on this question of whether to combine or not, because again, the implication to this question is whether the revenue profile changes. And so if the revenue profile is going to be consistent either way, we're not as concerned about combination. Well, so far the task force has concluded that we believe these items will generally transfer at the same time, and therefore whether they're combined or not will be less significant. So in particular, we've thought about electricity, capacity, and RECs, again, as kind of being the big three elements we'll see in these contracts. For electricity, we've tended to view the transfer of electricity over a customer contract term as a series. It's a performance obligation that's satisfied over time, and so the series model and the new revenue model will apply. And under the series guidance, we would apply what we call an output method to recognizing the revenue from the electricity. And we think that for electricity deliveries, the best measure of progress toward completion of the performance obligation is going to be a units produced measure. And so as each electricity unit is delivered, which will be the delivery month that they occur, revenue will be recognized. And so that'll be a nice way to track delivery, to recognize revenue consistent with the delivery term and profile, and achieve a recognition pattern that's very consistent with today's recognition pattern. For capacity, likewise, we think capacity would also be viewed as something that is satisfied over time. Capacity is basically a stand-ready obligation. A plant owner is saying, I'll stand ready to run my plant and provide you with electricity when you call on me. And my duty under a capacity contract is really just to maintain my plant's availability so that I'm ready when you do call. So under a capacity arrangement, we again think that it's a series. It's going to be satisfied over time. And we think in this case, a time-elapsed type of measure is the best measure of progress toward completing your performance obligation. And so really what will happen is every month that the plant stands ready to deliver and you earn your capacity payment, that'll be the month when you'll recognize that revenue. So again, consistent with electricity, it's very clean, and that the month that you actually perform is the month that you will recognize the revenue. So for RECs, the answer maybe isn't quite as clear, although we are leaning toward a view that the revenue from RECs would still be recognized in the generation month, the month that the corresponding electricity was generated. The reason that RECs are a little more complicated is there's this notion of a certification lag. And the way this works is when electricity from a solar facility is produced, let's say it's produced in December, the renewable energy credits that relate to that December energy are not certified and delivered to the customer's electronic tracking account until, let's say, 2 months later. So depending on the jurisdiction, that timing could be different. But the way this generally works is a third party certifies the amount of renewable energy produced and delivers a renewable energy credit to the seller to reflect that production, and then the seller can direct that credit to be deposited into the account of the customer. So because of that certification lag, a question arises as to whether revenue should be recognized at the generation date or whether revenue should be recognized at the certification date, the date that it's actually delivered to the customer. And one of the reasons this question arises is because the new revenue standard has a focus on control. The customer has to control the good or service before revenue can be recognized, and it's from the perspective of the customer. So many think that until it reaches their tracking account, they really can't do anything with it, and so revenue should not be recognized earlier than that date. So the unfortunate part of that view is, though, it certainly disconnects the event that gives rise to the renewable energy credit from the revenue recognition event. One of the ways the task force has thought about RECs is to think about something that's addressed in the standard called a customer acceptance clause. And there are provisions in the standard that say that if a seller delivers an item to a customer and there's a customer acceptance clause that just says the customer has to accept the good in order for the sale to be a good sale, as long as there are objective criteria that can be looked at and say as long as the good, the sold item meets these criteria, the customer should accept that revenue can be recognized at the delivery date. And we think a similar concept can apply for these renewable energy credits. We think that because the facility is typically pre-certified, because the facility's meter is basically what is audited to justify or validate the REC, we think those things are objective measures that can be looked at the generation date and used to justify recognition of revenue at the generation date. So again, in this case, we think that revenue from the delivery of a REC will be recognized at the delivery date, at the generation date, which in some cases will be earlier than delivery because again, the certification period comes into play and can actually lead to a disconnect between electricity generation and delivery of the renewable energy credit to the customer account. Not necessarily. I mentioned that for a series you would recognize the revenue, using some sort of a measure of progress, which would seem to imply straight line recognition. But actually, we think there are going to be situations where you could recognize revenue on a different profile, and in particular, there will be situations where a performance obligation accounted for as a series will be eligible for something called the invoice practical expedient. And this applies when the price charged for goods under the performance obligation is commensurate with the value that the customer is receiving. And so in many cases, particularly I think capacity is a good example, you could have capacity that's priced based on seasonal measures. And so capacity in peak periods, for example, is going to be more expensive than capacity in off-peak periods. So you could have over a long-term contract pricing that moves up and down depending on the peak and off-peak nature of the delivery periods. And today's practice is that sellers will recognize revenue at the actual invoice price to reflect the difference in the value of what they're providing in those various months. And so we think that under the new standard, this invoice practical expedient which only applies when you're dealing with a series, but since we think capacity and electricity are both going to be eligible for the series model, we think the new standard will also accommodate that type of revenue recognition. By applying the invoice practical expedient, you'll get to recognize the appropriate revenue in the appropriate periods and reflect the economic differences of those peak and off-peak periods. I think for the most part, what I went through today will probably result in practice that is very similar to today's accounting, particularly for electricity and capacity. I think that's going to be the case. For renewable energy credits, it's not quite as clear because we have some diversity today in practice. We have some companies that recognize the revenue from the sale of a REC upon the generation event. We have some companies that wait until the certification event. So because of the fact that there's diversity today in that particular aspect, it's hard to say whether tomorrow's accounting will line up exactly consistently with today's practice. But I do think that most of these answers are going to be viewed very favorably by the industry. It for the most part, accommodates existing practice, a practice that most companies believe is appropriate and reflects the economics of their sales. So I think these have been good issues to go through as an industry group, and we've reached good answers in almost all cases here. So this one is still at the industry task force level. We have reached a broad consensus on each of these issues, which is saying something, but we have not vetted these issues yet with the revenue recognition working group, so that's our next step.